All right, so let's go ahead and start with stock issuances. So if a company has stock, right, and if they're public or if they're a corporation, they have to have stock. That's kind of the definition. They decide maybe they want to sell that stock to the public, which again, they definitely can. It's their choice. Usually the board of directors will make that choice. So they decided to sell to the public. Let's say on their corporate charter, they have 1 million shares authorized. Now, just because that's the number of shares authorized doesn't mean that's what they're going to sell. It would be silly to sell all 1 million shares because that represents 100% ownership. So if you sold the entire number of shares, you'd be selling away ownership, all the ownership of your business. So let's say the company decides just to sell maybe 10% first for their first stock issuance. And let's say that the charter tells us, so let's say we have $1 million, 1 million number of shares. Let's say that the par value is 50 cents in our example, and we're going to stick with common stock. Okay, so that's our example for this one. So let's say on January 1st, the company decides to issue to record issuance of common stock when market price is $2 a share. Okay. Now remember, right now we don't have everything we need. We don't have number of shares. We don't have par value, but that should all be here in the corporate charter, right? There's the par value. Here's the maximum authorized, and then I told you we sold 10%. All right. So what's happening here is we have our corporation. They're selling off stock in their company to interested investors. The investors then are returning, they're buying it for whatever the market price is. They're giving us cash, so you're going to debit cash. Cash is always the market price per share times the number of shares. I indicated that we're selling 10, I think it's 100,000 shares. 10% of 1 million. And the market price is $2 a share. Okay, so we're getting $200,000 in cash. What are we giving? Excuse me, what are we giving the investors? We're giving them common stock. Remember common stock, it's been a while since we've seen this account. But we know common stock, that's the equity account, which means it has a normal credit balance. And it's always going to be recorded at par value. So going back to the corporate charter, we see the par value was 50 cents times the number of shares. Okay. Now we have a difference. Now, of course, debits have to equal credits, of course. So we have a difference of $150,000. That's going to go to a new account called additional paid in capital. Additional paid in capital for your common stock. It simply means, as it kind of states, additional paid in capital is the additional amount contributed by investors over the stock's par value. Okay, so that is the definition of that account. Kind of as the name says, additional paid in capital. It's the amount over par value that your stockholders paid in cash to the company. Okay, so it's for the difference between market and par. Market, par is the difference. Okay, and the difference in this example was 150 times the 100,000 shares. Okay. Some things about this new account, because it is a new account. This is an adjunct equity account. Remember, adjunct means the same direction. Okay, so that means it also has a credit normal balance, and it'll appear on the same financial statement as common stock, which is the balance sheet. And that is your journal entry for stock issuance. I guess the only other thing I'd mention is cash. This could be any asset. You can exchange a company's common stock for any asset. Just depends on if that investor is willing to take that or to give that asset, right? So instead of giving cash, are they willing to give something else? A lot of your startup companies in Silicon Valley will do that, right? Maybe they have a rent that they need. So they'll ask the landlord, hey, can we have rent for a year and we will give you common stock, right? So they're getting an asset. It just doesn't have to be cash. Okay, so that's the only other thing I'll mention. Of course, most of the time it is cash, but just wanted to mention that. All right, you did your journal entry for stock issuances. Common stock is always credited for par, so these will be your takeaways. Okay, common stock always recorded at par. Cash or whatever asset is received is recorded at market. APIC is the difference. Right, good job. So we covered the basics of corporate formation, the steps the company must take in order to incorporate. And we have reviewed the journal entries for stock issuance, the impact of those stock transactions on a company's equity. Remember, equity appears on the balance sheet. Balance sheet under equity. I don't know if you remember, it's been a while, but before the two categories that we had under equity were common stock and retained earnings. Do you guys remember that? It's been so long. Now we are going to expand that because now we've learned, well, a company could have common stock or they could have preferred stock, right? So now we're going to change this from common stock to what's called paid in capital. Paid in capital. That means all the money that comes into the company, this is money from stock-related events, from stock-related transactions. Okay, so when we sell our stock, common stock, we also learned that you might have an APIC account for that common stock. Okay, we're not going to really focus on preferred stock, but if we had preferred stock would appear along with APIC preferred stock. And then retained earnings. So now equity is going to be, again, those two categories, right? But we're changing it from common stock to paid in capital so that it includes all the components that come with those stock transactions. All right, in the next video, we will tackle treasury stock.